All right, let me ask you a question. And this question is pretty much geared towards newer option traders. If you're a buyer of an option, let's just say you're a buyer of a call option, which is a bullish strategy, and you buy that call option and the stock goes up, do you think you're going to make money on that option? Doesn't matter if it's a short-term option, longer-term option, whether it's an at the money or out of the money option. Do you think that just because the stock goes up means you're going to make money on that option contract? Well, I get a lot of questions from people that tell me, hey, Lee, I bought this call option, the stock went up, and I didn't make any money on it. How could that be? How could the stock go in the direction that I predicted and I still lost money on the option contract? Well, in today's video, I'm going to show you a few things. We're going to look at an option calculator, which is one of your best friends if you're an option trader. And we're going to run over a couple scenarios on how option prices change based on time and the strike price and other things that affect the option's value. So the next time that you buy an option, you'll be well more informed on how you can make better trades. And I'm going to offer a couple solutions as well. So if you want to see how option values change, because just because you get the direction right, I'm here to tell you, doesn't always mean you're going to make money. So if you want to learn a little bit more about how options react to price changes, stick around and watch this video. All right, so let's just get going here. All right, everyone, Lowell here from smartoptionseller.com. We make these free videos for the trading community because we all want to help each other out. We want to become better option traders. So here's what we're going to do. We're going to look at an option calculator today, and this is what you're seeing in front of you today on the screen here. And we're going to go over some what-if scenarios. An option calculator is a great little tool to use for what-if scenarios to see how your option value will change, an option value that you may have bought or sold over time, and versus the strike price that you choose and volatility rate and all that good stuff. But this option calculator right here is free. If you look up here, barchart.com is a great free website to get a lot of free tools. And if you look along the left-hand side here, let me move myself over. If you go to barchart.com and click on the options header right here, you're going to get all these things over here on the right-hand side. Click on options calculator, okay? So that'll bring you to the screen that we are in here now. Now let's focus on, we're going to type in Apple, the symbol for Apple, and we're going to choose Apple. And when you type in that symbol, it's going to bring up the parameters here. So if you've never used an option calculator before, let me just explain this to you a little bit. On the left-hand side here are what's called the inputs. Okay, these are the things that help give an option its value, whether it's a put option or a call option. There's a number of different variables or inputs here on the left-hand side that will spit out the outputs here on the right-hand side. The theoretical price is going to be the option value, and then you have the Greeks down here: delta, gamma, vega, theta, and rho. We're going to look a little bit on theta today, okay? So all these things here on the left-hand side, the underlying stock price, the strike price, the days to expiration, that's what DTE stands for, days to expiration, the interest rate, volatility rate, and the dividend yield. So the risk-free rate and dividend yield are the two items that really don't matter so much, that they don't give an options value too much. They don't have too much of an effect. So it's the other four numbers: the stock price, the strike price, the days to expiration, and the volatility rate. Those are the four main items that really help drive an options value that you'll see on this side. So in this case, we just pulled up Apple, and bar chart defaults certain numbers in here. It's last price, and they give an at the money strike, and how many days left to expiration, and the interest rate and volatility rate and dividend yield, all that good stuff. So you don't really have to know all that stuff offhand. Bar chart does that for you. And this is for a call option. So we're going to, if you wanted to choose something different, put option or call option, those are the only two. We're going to look at call option today. And right now we have 13 days left to expiration, but you can change all the inputs here. So I'm going to show you, we're going to look at a scenario and help you understand that just because the stock moves in the direction you wanted it to, doesn't always necessarily mean that you're going to have a profitable trade. And I'm going to give you some solutions to that so you can become a better trader. So let's concentrate on Apple call options because most people buy call options because they're bullish. And let's just change the expiration date here. Let's go out a little bit further in time. Let's change this to 33 days to expiration. And let's look at, for most people, they're looking at out of the money call option because those options cost less. Out of the money options is for a call option is the strike price is situated above the current stock price. So if current stock price is $222.91, that's where Apple closed at the end of this past week on November 1st, 2024. And we got the strike price of 230, 33 days left expiration, and we have these other numbers here. And it's giving an option value, that call option, that 230 strike, the 230 strike call option is worth $4.58 per contract, okay? And you have to multiply this by 100. There's 100 shares of stock in each option contract. It's called the $100 multiplier or the 100 share multiplier. So this option would actually cost $458. If you bought that call option with 33 days left, the 230 strike, it'll cost you $458. Now, in order for you to make money, the stock absolutely has to go up for the most part. Okay, we're gonna not talk about volatility here because if volatility goes up, the option value can go up as well. But we're making things simple here. We're only going to concentrate on the stock price and the days of expiration, and we're going to talk about Theta, which is one of the Greeks here. Okay, so we're going to concentrate on those few things. So $458 or $4.58 per contract is what the call option costs. If you're bullish, now you want Apple to go up in price. So that's the thing. You've got 33 days left in order to make money. How does that happen? Well, if the stock price goes up, the option value should increase as well. And what you can do with that is if you bought it for $458 and if this option value increases, you can sell that back to the market and capture a profit that way. Okay, that's how most people do it. They buy an option at one price. They hope its value goes up so they can sell it at a higher price and just lock in the game. So let's take a look here at Apple. Now, let's just assume that there's 33 days left. And what happens, well, before we do that, I want to talk about Theta. Theta is a number that tells you how much money the option will change due to a change in the date, okay? Theta right here, you can see it as a negative 11 cents, 11.3 cents roughly. Let's just round down to 11 cents. So what happens here is that all else being equal, once you turn the calendar to the next day, once you flip the calendar to the next day, this option value should lose about 11 cents per contract without anything else happening. An option is what's called a wasting asset. It decays over time. Its value decays over time because there's an expiration date. So as it moves towards the expiration date, the option value gets cheaper and cheaper. So if you're a buyer of that option, just because we turn the calendar to the next day means you're going to lose money due to the change in date, okay? So I just want to show you how this works. So today, with 33 days left, this option's worth $4.58. All else being equal, if we just knock this down by 1 day to 32 days, you're going to see this option value go down by about 11 cents per contract. So that should take it down to about $4.47 roughly. So here we're going to change this to 32 days, and you're going to see how it just dropped by about 11 cents. Okay, if we change it back to 33, it goes back up to 458. So all else being equal, if none of these other parameters change in 1 day's time, which they most likely don't, that option value is going to lose 11 cents per contract. So if you're the option buyer, just because we flipped the calendar to the next day, now you're holding an asset that has just lost 11 cents per contract or 11 actual dollars due to the passage of time. Now, the only way to combat that loss of time is for the stock to go up in value enough to cover the decay that you just lost. So let's see how much the Apple price has to move up in order to offset the 11 cents per contract. So let's take this down to 32. You bought it at 458, you just lost 11 cents. So Apple stock has to go in price up in price to make up for that 11 cents you lost. So let's say 223.10. It's almost up there. So let's go 223.20. Okay. So Apple had to go up about 29 cents per share in order for you to recoup that 11 cents that you lost to Theta. So not only does, if you're an option buyer, not only does the stock price have to continually keep going up because it's fighting this daily time decay. Okay. So you've got, as an option buyer, you've got these things working against you. Okay. Now, if the stock decreased in price, let's say Apple dropped down to 221, now you've lost over $1 per contract. In addition to that time decay. So this is why, if you know me, I'm an option seller. Okay. Because as an option seller, you're actually going to make money due to the passage of time, with all else being equal here. And that's an easier way, in my opinion, to make money, because as we're sleeping, we change the calendar the next day. Oh, my option value declined. As an option seller, that's what you want. If I've sold that option for $5, turn the calendar, now that option's worth $4.90 the next day, I've just made 10 cents per contract in my sleep. But getting back to how this works here, as the option buyer, the call option buyer, not only do you need the stock to keep going up in price to continually offset that theta decay, theta keeps getting bigger over time. Okay, so let's just take Apple back to this 223 level, and we'll reset it to the 33 days. Okay, so basically, you're losing about 11 cents per contract overnight. But as we dwindle down in time, let's take this down to about 20 days in time before expiration. You can see Theta is getting larger. Now it's over 13.5 cents per contract that you'll lose overnight. And the closer you get to expiration, let's change expiration down to 10 days. Now it's almost 17 cents per contract. So as you move closer to expiration, that daily time decay gets even larger, which means now the stock has to move up even more for you to offset that time decay as an option buyer. So it's really hard to make money as an option buyer because you have all these things going against you. All right. So there's a reason why we're called smartoptionseller.com, because we're smart option sellers. We sell options. That's our gig. We sell options. Let me just quickly bring you to our website here. Smartoptionseller.com. If you've never been here before, we're all about selling put options, not call options. We sell put options. We sell put option credit spreads. We're more option sellers. If you want to learn a little bit more about what we do, obviously you can go through our website, but you can get our free ebook here, which is all about put selling. If you don't know anything about put selling, get our free ebook, Put Selling Basics here. Scroll down. You can read a little bit about it and put in your name and email address, and we'll send you an email back with a link for a free copy of the book. If you want to go even deeper than that, you can look at our video series right here and our services right here as well. We have a couple paid newsletters in which we sell put options and put option credit spreads. We have our coaching as well. So take a look at those things. But getting back to the options calculator here, once again. So as an option buyer, in this case, we're looking at call options, getting the direction right and getting the timing right is really important. Not only the stock has to move, but it has to move in a certain amount of time. Now, the other thing I want to talk about is what happens if the stock moves really quickly in your favor versus taking a long time to move in your favor. So let's just put the parameters back here. We've got the stock price at $223, and you chose a call option strike price of $230 because you think Apple can get up to $230 in the next 33 days. And in this case, it's $4.62 that the option costs, $462. So what happens if Apple jumps up to $229 in one day, the next day? Okay, let's take this down to $32. Okay, so now that call option's worth $7.17 per contract. You bought it for, $4.58 roughly. So you just made yourself, $202.60 per contract. $260 you've made. Okay, you bought it at $4.58. Now it's worth $7.17. That's about $2.60 gain per contract. And that happened in one day. Okay, so Apple moved up from $223 to $229. It went up $6 per share just in one day. Now, you're really happy. Your option value is going up. But let's see what happens if it took, let's go down to 1 day left before expiration. And Apple still went up. It's at $229, but it took 32 days to get there. Now look at what that option value is worth, 86 cents per contract. So the point I'm trying to make here is that the speed of the movement is very important as an option buyer. Apple went up from $223 to $229. It went up $6, but in this scenario, it took 32 days to get there. But your option value didn't make any money. You bought it for $4.58. Now it's only worth 86 cents. If it happened in 1 day overnight, yes, you can sell that option for more money. But if it took 32 days to get there, if Apple took 32 days to move up $6, you're not going to be able to sell that option for a profit. You're going to be taking a loss. So not only as an option buyer do you have to get the direction right, but it has to move very quickly. Now, I said I'm going to show you a couple solutions, or tell you about a couple solutions. So let's go back to the original here. And Apple at $223, right? So, $462, that was the price. I'm not sure why I was saying $458, but regardless, you understand how it happens. Now, in order to combat the Theta, one of the things you can do is use a longer time frame. Okay, you can go out 90 days. You can see now Theta is only about 7 to 8 cents per contract that you lose overnight, but the option does cost more money. Okay, so you're giving up one thing for the other. You're giving yourself more time, and you're getting less theta decay, but the option will cost more money. One of the things I tell a lot of people that come to me for coaching is that you want to give yourself more time to be correct. Okay, choosing short-dated options. Most people think they can figure out where a stock's going to go in a very short period of time, and once they're into it, after a while, they realize, God, the stock's just not moving in my favor fast enough. So one of the things you can do to combat that is give yourself more time. Yes, the option will cost more, but the probability of the stock moving in the right direction is higher. As long as you pick a right company and the stock's in an uptrend and you're checking the charts and the stock should keep moving in the uptrend, then you should make money on the trade by giving yourself more time. That's just how it is. And you're going to lose less money to daily time decay. So now you're only losing, 7 point something cents per contract. As we go down 89 days, we lose 1 day. You're still you're still below 8 cents per contract on a decay range here. So let's go back to the 33 days before expiration. You can see the theta is 11.3 cents. If you go down to 32 days, the theta goes up as well, but it doesn't go up as quick as a longer dated option. All right, let's just take a look here. I'm going to show you these examples. So at 33 days before expiration, you're losing 11.4 cents roughly. Let's take it down by 5 days. Okay, now you're losing 12.1 cents. So that's almost a full cent per day that you've lost in the 5 days. It was 33 here. Okay, you're losing 11.39 cents. Take it down by 5 days. Take it down by 5 days at 28. You're losing 12.1. So it's gone up almost a full penny. Now, if we look at the 90-day expiration, you're losing 7.6 cents. We take it down 5 days, 85. It's not moving nearly as quickly as those shorter dated options. So As I said, theta really increases the shorter you get to expiration. So there's that's another reason why lengthening out the days to expiration can help your trades, can help you from losing so much value to time decay. Okay. The other thing you can do is, instead of buying these, out of the money options, you can buy an at the money option. Those will cost more as well, but if the stock moves, you're going to get that option value is going to move more as well versus an out of the money option. Okay. So let's just say you chose a 223 option, 223 strike, Apple's at 223. And let's say it goes up to 229 like you thought, and you're going to make a lot of money on that trade here. Let's go back to the original equation here. With 33 days left and the stock was at 223, okay, we're just going on a new example here, and you bought an at the money strike. That's when the strike price is pretty much the same as where the stock price is. 223 strike, 33 days left. It's costing $7.58. If Apple goes up to 229 in 1 day, 1 day later, you've made, you've made $3.50 roughly, $350. And even if you take it down to 1 day left, you still didn't lose as much money as you did with that out of the money strike. You bought it for $7.58. It's worth $6.06. You've lost about $1.50 in value. But remember, when you bought that out of the money contract, which cost $4.70 something cents, on the last day, it's worth 86 cents. So you've lost more. You've lost over $4 there versus here with the at the money strike, you only lost about $1.50. So buying an at the money contract, an at the money strike, can do better for you versus an out of the money option. Even if with the stock going in the right direction, you won't lose as much money with an at the money strike versus an out of the money strike. So that's another thing to look at. Changing your strike price, changing the, going longer out in time in your days to expiration can really help you either not lose as much money or make money as the stock goes up. The last solution that I want to talk about is buying multiple options, because if the stock moves in your favor and the option value goes up, you can sell part of your position to at least play with the house's money. Now, let's just say, some of you may know this already, let's just say you bought, a contract for $2 per contract, and you bought 2 of them. Okay, so now your full cost is $400 that you've paid out. Now, if the option price goes up because the stock goes up, you can sell one of those. Let's just say it goes up to $4 per contract now. You sell one of those contracts, you've recouped your whole investment, and now you're playing with the house's money. If you've got one contract left, if the stock keeps going up, you'll make more money. If the stock craps out to zero and the option expires worthless, well, at least you've broken even. So the other thing I can suggest is that if you're going to buy options, buy in multiples. Buy at least 2 contracts if you can afford that. Because if the stock goes up and the option values goes up, at least you can sell one of those contracts off, recoup some money, and now you're just playing with the house's money. And that, that's better than, losing your money. So those are the few things that you can do to help you as an option buyer. Go longer out in time. Use an at the money strike instead of an out of the money strike, or buy in multiple contracts so you can sell one of those off as the stock moves up and the option value will move up. We're talking about call options, okay? So that's the lesson for today. I hope it's been helpful. Use the option calculator to help you understand how things move, do what if scenarios, understand that theta. Theta is really important as an option buyer. You're going to have to somehow get over the hump that the money you lose just because you change the calendar, the stock's got to keep going up. So be wary of that. Down in the description below, I've got links and websites and books and things to have a look at that could help you out as well. We've got some option scanners / screeners that you can take a look at if that's something you want to do. Give me a thumbs up, give me a like, leave me a comment. On the screen here, I'm going to put another video that you can watch all about picking the proper strike price. Talked about some of that today, but you can watch the other video to help you as well. All right, so that's it for me today. I'll see you all in the next time around. This is Lowell signing off.